Welcome back to the portfolio, everyone. And in this video, we're going over the 7 Dividend Kings you should keep your eye on right now. Dividend Kings are companies who have been paying out a growing dividend for over 50 consecutive years. So all 7 of these companies have been growing their dividend payment through good times and bad times, through times of economic boom and recessions and depressions, and these companies have proven to weather every storm and continue to grow their dividend payout for at least 50 consecutive years. These companies have extremely long dividend histories. They have very strong established brand loyalty and revenue cash flows. So in this video, we're going to take a look at 7 different Dividend Kings you should keep your eye on right now. Before we jump into the first pick, as you may know, everyone, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy, overall stock market performance. We follow along with my personal dividend portfolio, and we always discuss big market news and headlines. So please hit that like button and subscribe. I'm going to jump right into the first stock on this list, which is Lowe's. Ticker symbol LOW. This Dividend King is currently being traded at $166 per share. With a market cap at over $125 billion, this company has been raising their dividend for an extremely long period of time. They currently yield 1.44%, have a payout ratio of only 28% of earnings, and have an extremely high dividend growth rate, averaging over 20% annual growth over the past 5 years, and they've been growing that dividend for 57 consecutive years. So with the world we're living in today, where people are spending more time in their homes, individuals have more money to be spent on improving their homes. Because of the forced stay-at-home orders, people want to improve their living spaces, and they're spending more money at these home hardware / home improvement shopping centers, such as Lowe's. So they've done a beautiful job of growing their dividend at an insane rate of over 20% for 57 consecutive years. And they have a 93 dividend safety score, which represents extremely safe, which this is a company where we will not see a dividend cut coming anytime soon. The second Dividend King to keep your eye on right now is J&J, Johnson & Johnson. They've seen a decent decline over the past month. Shares are down 5%, and they've seen a pullback away from their 52-week high. Market cap at over $385 billion. This is one of the largest companies on the S&P 500. Current yield at 2.7%. This company has very strong established products in the consumer space. This company will be here for a long period of time, and their healthcare products are staples in individuals' daily lives. They have a current yield at 2.76%, a 51% earnings per share payout ratio, which is very sustainable, and they've grown their dividend on average of over 6% over the past 5 years, and they have been growing their dividend for over 58 consecutive years. Once again, this is a healthcare company that will not be going anywhere anytime soon. Taking a look at their dividend safety score, they're coming in with a 99. Considered very safe, this is the highest dividend safety score rating possible from Simply Safe Dividends, and this represents a company where their dividend is very, very, very safe, extremely unlikely to be cut anytime soon, and this is a Dividend King that will continue to generate revenue and net income in order to return it to shareholders in the form of a dividend for a very long period of time. And they have a beta at only 0.69, which is considered low. So if you were to buy into this Dividend King, you'd lock in a nice average 2.75% dividend yield, which is a very safe growing dividend, and your share price isn't going to be as volatile as the overall market. The third Dividend King to take a look at today is Proctor Gamble. Ticker symbol PG, currently being traded at $138 a share. Another extremely large company with a market cap of $343 billion. Current yield on Proctor Gamble at just under 2.3%. The company is up 14% over the past year, and over a long-term span, shares are up over 90% on the 5-year chart. So very long, consistent share price growth, tied in with a nice average dividend yield of over 2%, this is another Dividend King to keep your eye on. This company currently yields 2.29% with a 58.57% earnings per share payout ratio, another earnings ratio where this company has sustainable amount of earnings where they can reinvest money back into the business in order to grow operations and can sustain growing that dividend payment each and every year moving forward. an average dividend growth rate of over 3% per year. Although that isn't anything super exciting, what that represents is a dividend that is growing to either match or slightly outpace inflation each and every year. So you are actually maintaining your current buying power each and every year with this dividend increase. And they have been growing that dividend for 64 consecutive years. And their dividend safety score comes in at 99. Once again, the highest possible dividend safety rating. So this is another Dividend King where your dividend, if you were to buy in today and lock in that 2.3% starting yield, over the long term, it is expected for P&G to continue to grow their dividend each and every year without any hardship. The fourth Dividend King is an investor's favorite, CocaCola, one of Warren Buffett's favorite holdings, ticker symbol KO, currently being traded at around $49 a share. Down 7% on the 1-year chart. You can see here they took a hard dip in the month of March, like the entire market. We saw a slight recovery, but shares have actually been trading flat from that first recovery point back in April. So still down over 7% over the past 12 months. The market cap at over $212 billion. And on the 52-week range, you can see here they're being traded on the middle. So this may be an attractive price point to jump in and lock into a nice position in Coca-Cola, the Dividend King. Currently yielding 3.3%. They have a very high earnings per share payout ratio of over 90%, which is high, and the company has to work on bolstering up some net income in order to reduce that payout ratio. And they've been growing their dividend at a rate of 5.57% average over the past 5 years, and they have a 58-year dividend growth streak. With regard to dividend safety, they're coming in at 80, which is still considered safe. So although their dividend payout ratio is on the higher side, this company has a lot of strong brand loyalty, and once restaurants and other kind of fast food establishments open up again and the demand for their products picks up, I believe Coca-Cola will see a nice rebound, and overall the company will be able to maintain and grow that dividend payment for future years to come. Stock number 5 is Colgate, ticker symbol CL, $77 a share. This company is up 9.76% over the past year. Just under their 52-week high, which came in at $80 a share. This company has a current market cap at $66 billion. If we take a look at their dividend, currently yielding 2.27%, a sustainable payout ratio of just under 60% of earnings, and they've done a nice job of growing their dividend, once again, just slightly outpacing inflation at an average of 3.79% over the past 5 years, and they've been doing that for 57 consecutive years. Their dividend safety score comes in at 90, which is considered very safe. This is a company where, once again, we will maintain and continue seeing growing dividends year over year, kind of without worry. Their cash flows are very sustainable. We believe the dividend will continue to be very safe over the longer period of time, and overall this company will continue to reward shareholders with nice cash payments every quarter. Stock number 6 is Stanley Black & Decker, SWK, currently at $164 a share. Stock is up just under 21% over the past year, and you can see here they saw a massive decline in the month of March, but have slowly seen a recovery back close to pre-pandemic highs. Market cap at only $26 billion for this company. This is one of the smaller Dividend Kings on the market. The current yield of 1.7%, which is on the low side, but this is a company where they're only paying out around 35% of their earnings in the form of a dividend. So they have a lot of cash left over, and retained earnings are high for this business. So overall, they can do a nice job of continuing to grow operations, use that extra net income that is not being paid out in the form of a cash dividend to help grow the business, expand operations, and of course, maintain increasing that dividend each and every year. And although your starting yield is on the lower side, they are growing that dividend on average of 5.77% over the past 5 years, and they've been doing this for 52 consecutive years. Their dividend safety score is still considered very safe, coming in at 90, another company where you're locking in a nice, very safe dividend, but you're getting a lot of high volatility. A beta of 1.56, shares are very volatile in this stock, so be aware of that when evaluating the company. The 7th and final Dividend King we're going to take a look at today is California Water Service Group, CWT, with a market cap of just over $2.2 billion. By far, this is the smallest Dividend King on this list. Shares are down 13% over the past 12 months, and overall on the 52-week range, shares are being traded toward the low side. They have a low dividend starting yield at 1.89%, but are paying out under 60% of their earnings in the form of a dividend. They've grown that dividend on average of close to 4% per year over the past 5 years, and have been growing that dividend for 53 consecutive years. So another interesting company to keep your eye on this year. And over the past few months, this company has been on the decline, so we might be at a nice attractive price point to jump in and start a position. 99 dividend safety rating, once again, extremely high, very safe dividend, the highest score possible, just showing that this company is very unlikely to cut that dividend anytime soon. So those were 7 Dividend Kings you can keep your eye on right now. They all pay dividends for over 50 consecutive years, and they've been growing those dividends each and every year. And these are companies that have survived very tough times in the market. They've gone through hardships and continue to grow that dividend payment. So these are dividend investors' favorites. So if you're looking for some nice Dividend Kings to add to your portfolio, take a look and examine one of the 7 that we talked about today. So thank you for watching, everyone. I am the Gen Z Investor, and I will see you in tomorrow's video.